we're going to do essentially the same presentation for the clients, the ones that have signed up for the PPACA, just to, again, give them an idea of where they're at, where they should be in this process, and how to use the FMS tools in order to accomplish the ultimate goal of getting the data uploaded into the PPACA module. So Bonnie and I are going to tag team this. Bonnie's going to go over the concepts, and then I'm going to do some of the technical things with inspecting the data. So with that, Bonnie, I'll go ahead and make you the presenter. And you'll want to click on Show My Screen. Are you able to click? Bonnie, are you there?
Hold on, I'm still looking for my thing.
Okay, great. No problem.
Okay, so what do I have to click on?
Show My Screen, or the play button.
I'll see that.
There you go. We can see you now.
Okay, good. Okay, let's get started. Basically, I just want to go through, again, a very quick overview or high level of what the ACA is. Basically, what it does is it requires all employers, or all employees to have health coverage. So, or they're going to pay a tax penalty. Basically, what that caused was the setting up of all the health benefit exchanges, because what they're saying is, you know, if you have to have health coverage. So if you're not covered under an employer plan, you can go to this health exchange so that you don't have to pay a penalty for not having coverage. In addition to that, what it did was it makes all employers also responsible to now offer coverage to their employees, or they're going to have to pay a penalty. So that means that as of this year, any full-time employees over 50 should have been offered health coverage as of January 1st of 2015. There's going to be two types of penalties that the IRS is going to impose on the employers. And basically what they're going to be is a no coverage penalty if we're not offering coverage to employees. And then there's also going to be an affordability penalty, which means that they offered the coverage, but it was not considered to be affordable to the employee. So they will also give a penalty for that. And then, so what do employers have to do so that they don't have to pay these penalties? Basically, here are all of the steps. We've broken it down into 5 different steps, and what we're going to do is we're going to talk about each step individually and then show the examples and how you actually do that in our system to complete that step. The first one is to determine if your company is an ALE employer. An ALE employer is someone that has over 50 full-time employees that are now working. Our full-time employee is defined as someone that's working 30 hours or more per week on an average. It's no longer the 40 hours, it has to be the 30 hours. So that's the first thing to do. You need to find out if you are an ALE or your company is an ALE. You have more than 50 full-time employees that are averaging over 30 hours. Then you're going to need to make sure that you go to step 2 once you determine that. The next thing you'll need to do is make sure that you have insurance. You need to get with your insurance company or get insurance if you don't already have one that's affordable and meets the minimum value and the minimum coverage to offer to employees. And basically what that means is in this law change, they have identified certain requirements that have to be met in order to be considered affordable and provide minimum coverage. So you have to make sure that that insurance does that for you. The other thing is, once the employees, oh, completely lost it, never mind. Then once you have your insurance secured, now you want to go to step 3. You have to define an appropriate look-back period or measurement period. And basically what that means is that you go back to the prior year and you figure out all of your employees that have over the 30 hours and are considered full-time. And those employees are the ones that you're going to offer this minimum essential coverage and affordable insurance to as of the beginning of the year or the beginning of your plan year. Then after you do that, you go to step 4 and monitor your new employees coming in. You should give them an offer of coverage within a 90-day wait period. Then step 5 is you got to compile all the data that's required of the forms that have to be sent to IRS at the end of the year. There's new forms that have to be sent, 1095-C or 1095-B. You also have to supply those forms to all employees and report them to the IRS. And as of this time right now, and where we're at in the year, you should be in step 5. Then, of course, step 6 is actually providing them to the employees and sending them off to IRS by the end of February. So then the first step we're going to go through is the step 1 to determine if you're an ALE or a large employer. We talked a little bit about it, but I want to go into just a little bit more detail. A full-time employee is considered an employee that works at least 30 hours in a week or 130 hours in a month. Those are the employees that will be considered full-time. So if you have 50 or more people or employees that are working those hours, they would be considered full-time. In addition to that, they've come up with a new status of employee called a full-time equivalent. And basically what they're saying is that not only are you going to take all of those full-time people that are working over the 30 hours, you also have to include all of the hours that are worked by the people that work less than 30 hours or part-time people. And basically what you would do with that is you would add all their hours together and then divide them out. And basically what you're doing there is you're coming up with a number that it's going to combine some of those hours to come up with one full-time employee. So that could significantly change your full-time count. So it's very important to keep that in mind. You have to go through and take those full-time equivalents and do the calculation, add up all hours, divide the hours by each employee, and then determine how many of those are now considered a full-time employee. Then in addition to that, there's also a control group or a related company. So if you have more than one company that is related in any way, you have to make sure that you do those counts, all of these counts, for all of those companies. It's not by FEIN or anything like that. You have to do it for all companies that are related in some form or manner. You have to also ensure you include your seasonal employees. There's a calculation to go through for those. You go through if they've worked 120 days and they're averaging over the 35, then they are over the 30 hours, they can be excluded from the count because they're seasonal. So you have to keep those in mind if you have a lot of seasonal employees. Okay, so now I'm going to turn it over to Chris, and he is going to go through all of the reports and everything on how to do those things we just talked about.
Okay. Okay. Bonnie, can you see my screen now with the Excel spreadsheet?
Yes.
Okay, great. So this is the average hours report that everyone should be familiar with right now, or by now I should say. On the payroll menu, when you go into employee reporting, it's the last one, the newest one, healthcare reform report, or I like to call it the average hours report for the ACA. The client that I'm using an example is Kenny's 470, and I'm running it a lot of different ways, but for the most part, the date ranges, can vary depending on what kind of data you're looking for. But for the most part, I'm running it for all employees. We default to active only, but I'm typically running it for all employees to show me inactive employees that were active as of the date. Okay, because active only means literally active as of today. So if I'm running it historically, I need to run it for all employees in order to get those that are now terminated but were active based on that historical period. I'm including salary just for the heck of it to include them, and then I'm doing all employment statuses. And everything else I'm leaving blank because I'm not concerned. I'm going to filter using Excel for the average hours, and I don't have, let's say this particular client, for example, doesn't have necessarily any kind of a pay period selection. This was if there's a minimum number of pay periods that you want to see for an employee. Like show me only employees that have been active, 3 pay periods, and that's really to filter out anyone that's in the waiting period. So you want to just look at, active employees as of today that are out of their waiting period for health insurance, and so that they would have an active offer. And then we have a different method to count pay periods as well. So, those 3 pay periods, when do I begin to count those 3 pay periods? And you could say there's basically begin on the all pay periods after hire, or the newest method we added was begin on first full month. So if the employee was hired on the 15th, the pay period count or the waiting period doesn't even start until the first day of the first full month that they're employed. So you can run it either way, but I'm just going to leave those blank because I'm not looking for minimum pay periods. I just want to run it for everyone. It creates the file XHCR report, healthcare reform report, and that file can be downloaded with the data transfer. We've reviewed this in the past, and all the details, by the way, are on the public folder on the F drive under public and then PPACA information. This is all in the folder called Average Hours Report. There's an example, there's the manual for the clients, and an example download. Of course, AS clients, or OIS clients, I'll call them, can't download files themselves. So if the file needs to be downloaded to Excel, the best way, the accountants have to do it for the accounting services clients, those on the OIS menu. But accounting services clients that have their own environment, like full menus, not OIS menus, they should be able to download data because they're not in a shared library. They're in their own library. So they can download their own files. They can download this file after they do it. But clients in accounting, the AS environment, Seattle environment, the accountants have to transfer the file and give it to the client. So it's a CSV file, which can of course be opened in Excel. This is the report that I'll be kind of sharing for the rest of this is the primary report for all the functions that Bonnie just talked about. All the steps most of the data can be received from this report. We tried to make it robust enough that you can get everything from it. So this is the primary report that I'm going to use. So Bonnie talked about 2 classifications for employees, full-time and full-time equivalent. So your full-time is really your average hours over 30 or more. So that's right here, this average hours, and I put filters in Excel so I can just say, okay, show me everyone that's greater than or equal to 30. So down the bottom left-hand corner, I've got 164 employees. Okay, so if I just keep a record of that, 164. Then the full-time equivalent is basically where you merge 2 employees together to make an equivalent full-time employee. Okay, so if you've got 2 15 average hours employees, they combine to make a 30 full-time employee. but it's really based on their total hours. So if I clear out my full-time, and I actually want to just look at anyone that's under 30 hours now, because I already did the over 30 hours, so I want to do less than 30. Okay, now basically I want to add up all these hours and then divide by the 120 hours per employee to get my full-time equivalents. However, there's one more step before we do that, and that's to limit the hours to 120. So anything more than 120 hours, we aren't concerned about. So that's where, for example, an Excel formula will come into play, so that we can take the hours and say, okay, if the hours are greater than 120, then limit it to 120. Otherwise, give me the hours. So Q5. So for example, if I drop this down by just double-clicking on the bottom right corner of the cell, it drops the formula all the way down. So for example, this employee here at 129, so it limits it to 120. And then essentially, we just want to subtotal this column to get the total hours. Whoops. How do I do that? Go to the bottom, and I'll just hit subtotal here, and I want to start at row 2 and go to the bottom. So I've got 25,000 hours here, and then I'll just do another formula to divide that by 120. So I've got 216 full-time equivalent, 212 full-time equivalent employees. So I add that to my full-time employees, and I'm rounding down. I've got 376 total full-time and full-time equivalent employees. So of course this is more than the 50, so I am an ALE member. The only difference, or the only exception to all this, is for seasonal employees. And let me also back up real quick before I start talking about seasonal. I did this just for 1 month. The law says you got to look back. You have a look back period of 6 to 12 months, whatever the employer decides. So basically, you would run this by month and then just average all the months together. So if you have a 12-month look back period, you would determine your full-time equivalent employees by month, and then just add them all together and divide by 12 to get an average for the total, an average monthly full-time equivalent. And that's where the 50 employee threshold comes into play. But again, I was starting to mention the exception here is the seasonal employees. So basically, let's take an example of a grocery store at a beach, for example, where 4 months of the year they're busy, the other 8 months they're not busy. Okay, so they hire a lot of employees during those busy months. So if we have an employee, a client, they're on the fringe, let's say they have 45 full-time equivalent total employees for 8 months, that's 360, and then the other 4 months they go way above the threshold and they have 100 FTEs. So that's 400. So we're going to add 400 in there. So if I divide by 12, that's 63. So that's above the 50 threshold, but because they're only above 50 for 120 consecutive days, or 4 months, the way I'm putting it, that's considered seasonal. And therefore, even though they're over the threshold for the year, they're seasonal employees, so they're not considered to have, they're not considered to be an ALE. So that's step 1 to determine ALE status. Bonnie, I'm going to turn it back over to you.
Okay, I just want to add a quick comment on that. that whole scenario that Chris just went through to determine the ALE status and determine the FTE employees, those FTE employees, or that whole calculation, is strictly only to determine ALE status. None of the FTE employees or anyone in there has got to be offered coverage. It's strictly just to determine ALE status.
Right, and again, ALE is applicable large employer. Those are the employers that have to offer the coverage or else face the fines.
Okay, so I'm going to move on to step 2.
I'm going to go back and make you the presenter, Bonnie. We got to toggle here back and forth, so just click on Show My Screen.
Okay.
Okay, there you go. We got you.
Okay, step 2 for the employers are to make sure that they are either obtain coverage, health coverage that is affordable and meets the minimum essential coverage. Basically, what they're going to have to do is get with their health care provider and determine where their health coverage currently is, or obtain coverage that meets these requirements. I'm sure that all of them would have any contact you make with a health provider would understand what these requirements are. I mean, there is a lot involved in that, and it's way beyond anything that I could talk to. So they need to contact their health provider. And just to give you an overview, basically what it is, to pull all this together, is they're expecting the employers to provide at least the minimum coverage that an employee can get from the health exchange. So that's basically where that's coming from. And then they have come up with formulas and ways that employers can determine if their coverage is affordable. And that's the next thing that we're going to go through. Basically, the report that Chris is showing us is covering the rate of pay safe harbor. You can also use a W-2 safe harbor and a federal poverty line safe harbor. But what we are showing our customers, or what we're showing, is how to use the rate of pay safe harbor. Okay, back to you, Chris. Are you there, Chris?
Yep. Sorry about that. So same report, and I'm going to skip down to the end. This is where we've got wages, affordability, and insurance premiums. I did forget to talk about two pieces of setup for the average hours report, and this, of course, reminded me. You really have to set up what earnings codes are included in the wages and what deductions to include in the insurance premiums. So really quickly, we've reviewed this before, but I'll show you again. System maintenance, clients, and when you highlight a client and go under options, there is earnings and multipliers, and we added a new column here for HC. So you just want to flag any and all as yes. Most clients are just flagging everything as yes, just to be sure, even if it's not a productive hours. So mostly in the eyes of the law, all hours should be included here. And then that's the earnings. The other side is the deductions. That's a very simple, when I go into a health insurance deduction and you go into options on the second page, there's a healthcare cost option. This is what the report is looking for. So this is turned on. It's going to have an asterisk on the left. And deductions, employee deductions for this deduction code will be included in the report. So that said, we're essentially, what we're doing here is looking on an employee-by-employee basis if their total insurance premiums are affordable. So again, I'm looking at a look-back period of a year. I'm looking at 2014. Okay, so what we've got here towards the end is total wages, which of those are flagged as taxable back on the earnings and multiplier screen. And then when we go to affordability, this is actually the rate of pay affordability. So the rate of pay affordability is essentially 30 hours a week at their rate, at the employee's rate. So we've got the employee's hourly rate over here, and what we're doing on this affordability column is we're multiplying it by the number of pay periods that the report was run. So I ran this for a year. It's 52 pay periods. So even if they work less, we're still calculating an annual affordability here, okay? So we're taking the rate of pay, multiplying it by essentially 30 hours, and then multiplied again by the number of pay periods. And the ceiling multiplies it by the affordability ceiling that we entered when we ran the report. So if I go back into employee reporting, health insurance, healthcare reform report, this ceiling factor here, the 9.5% of their wages, of their rate of pay, is to determine affordability. So I've got affordability ceiling, and that's really the 9.5% of the affordability. So all I have to do at this point is compare it to the next column, which is total insurance. So this is the total deductions for this employee, so with the deduction codes that were flagged. So I could obviously set up a very simple, you know, affordability ceiling minus the total insurance, and I should have obviously some money left over. That would tell me that it's affordable. So if I drop that formula down, anyone that's negative would be an issue. Now, we also have to filter out my salaried employees. So I can do that very quickly where I take out if the hourly rate is 0. Okay, so you can see that there's some employees here that for whatever reason, they've got some really high health insurance. So maybe that's, you know, I don't know why. I mean, there's a number of reasons, obviously. But this is where we're comparing the affordability ceiling, the 9.5% of their rate of pay at the 30 hours a week, or 60 hours a pay period if they're biweekly, and then comparing it to the total insurance premiums that they were deducted for the year. This could also include insurance that might have been for the entire family. That's another, obviously, factor to take into place. If the employee is paying for, you know, spouse and dependents, then it's going to be inflated. And in the eyes of the law, usually everything is calculated just on single employee-only coverage. So again, a calculation here is basically what's going to determine very quickly if you have everyone under the affordability. And in the eyes of the law, I believe it's 95% of employees. Is that correct, Bonnie?
Yes.
Have to be affordable. Okay, I'm going to switch it back over to you.
Okay, the next thing is step 3, and basically what that is doing is now we have to set up a whole process that has to happen, and it's going to be year after year. The first part of the process, and what you're doing here is you're determining on a yearly basis if you're who is a full-time employee, who is not a full-time employee any longer, so you don't have to offer them coverage for the next year. It allows you time to go through those steps and then making out all of that information, and then a stability period, which is basically your plan year. So the first thing you want to do is go through and determine your average hours. So in our example here, what I tried to do in the measurement period was come up with what that would entail. So for 2015, the measurement period that I'm showing as an example here is October 1st of 2013 through September 30th of 2014. So on that report that Chris just showed us, we would put those dates in there, and that's where you would start looking for the people that are averaging this 30-hour threshold. And basically what you're doing there is trying to find who needs to be given an offer of coverage that's over the 30 hours, and who needs to be taken off of the new or upcoming plan year because they're no longer getting the 30 hours. So the administrative period then is the time that they allow for you to be able to do all of that. In other words, you have to identify your employees, you have to come up with their packages, you have to do all of that information during that administrative period. So in this case, it's only, it cannot be any more than 90 days. And I keep seeing everywhere that, so you have to be really careful with these measurement periods, because apparently, you know, when you say 90 days, most people think 3 months, but apparently 3 months is actually like 32 days or 92 days. So that's how detailed some people are getting into the data here. Then the next one is the stability period, and that's basically the plan year. That's when everybody's on the coverage. They won't come off the coverage until the end of the plan year, unless they terminate, of course. So then it's going to start all over again. So in this example that I have here, your measurement period is from October to September. You're identifying those employees over the 30 hours. You've got to make an offer to. The administrative period, now the measurement period and the stability period do not stop. In other words, like this measurement period, even though I have in here September 30th to do your measurements, the stability period still has to go through that whole year. In other words, during the administrative period, you would not take employees off of their coverage. They have to stay on for the full stability period. The measurement periods can be from 3 to 12 months. I'm not sure, you have to be real careful with that, because in a lot of cases, if you drop down months, you know, your averages might go up, or, you know, but you just have to figure out what's best for you. The administrative period can be no more than 90 days, and the stability period is usually your plan year. It has to be the exact same length as your measurement period. So if you're using your plan year to do the stability period, then you're going to have to use that same time frame for your measurement period of the prior year. Okay, so that's it. So I'm turning it back over to you, Chris, for the examples of the periods.
Okay. So I'm just going to go over the measurement period, because the administrative period is very similar to step 4. And of course, the stability period is just your plan year. So that's just a period of time where you're offering all your coverage. So the measurement period is probably the most simplest way of using this report. That's where you're really just running it for the time periods that Bonnie was referring to, and then you're just looking for your employees with average hours, you know, greater than or equal to 30. So you're basically just, okay, everyone that's on this list that had 30 or more average hours. This is different, again, from the whole full-time equivalent thing. We're really just looking for employees with 30 or more average hours. And we've got a list of employees here that basically these are the employees that we've determined are full-time employees and therefore required to have an offer of coverage. Just simply using the average hours during that measurement period. Okay, let's move on here, Bonnie.
I just wanted to add to that. The measurement periods and all of these periods actually can be determined by individual employers. I mean, these dates that I put here are just examples to show you how they flow. A lot of employers base their insurance plans on fiscal year, where they may have open enrollment in July and things like that. So they would have to adjust these dates to meet their requirements. So I just wanted to make sure everybody understood that these aren't set in stone dates, it's just examples.
Okay, I'm going to pass presenter back to you.
Step 4 is just really pretty basic. What they're saying is that there's also an initial measurement period, and basically what that means is that you have to monitor any new hires for up to 90 days to see if their hours are going to average the 30 or more hours, and that you have to give them an offer of coverage for insurance. And that would pretty much be the exact same thing that Chris just showed you, only now you're just looking for people that were just recently hired or have a new hire date.
Yeah.
And now it's step 5, which is providing the forms, 1095C or 1095B, to all of those employees that you did the offer of coverage and enrolled in the health insurance. So now we have to provide information to the IRS and to the employees about those offers that were made. And it's important to understand that it's offers. It's not just employees that signed up for coverage. It's everybody over the 30 hours that were given an offer, whether they signed up for the coverage or not. They still need to have one of these forms, and there should be a code that explains why, you know, they don't have coverage, or it would just be blank or so on, because you're reporting offers, not actual true, only those employees that have coverage. Okay, Chris, there you go.
Okay. So this is the majority of the work, and I'm switched to the 1095C. This is the form that's going to go out to every employee, every full-time employee. Also, for employers that are self-funded or self-insured, whatever you want to call it, they also have to send this form out for part-timers that are enrolled in coverage. But for the majority of the clients that they're not self-insured, this is going to go out to full-time employees to show you, to show them what they were offered by month. So let me start with, of course, going through the application in order to input this data. So when we go into the health insurance reporting menu and into the employee offering coverage, I'm in, let's see, I'm just going to go back in here. Essentially, we just list all the employees. Everything is stored by plan years. Well, I'm not going to call it plan year, I'll go calendar year, because of course that's what the IRS form is. It has to be submitted every year. So we've got everything organized by year. So when we come in, we just get our normal list of employees. So essentially, you can highlight an employee and go into work with offer and coverage. And this is where we're adding the offer and coverage record. So the offer and coverage record represents lines 14, 15, 16, and then there's an extra indicator for the full-time employee. And then we just do a range of months that these codes should be applied to. So for example, if this is a full-time employee, employed the entire year, that's getting a qualifying offer, we'll just put in 1A, and box 15 and 16 aren't required, and then check the box that this employee is full-time. So we can key it in this way for the employee. Now, of course, this is a very easy example, convenient for this demonstration, but you know, for example, in the case of an employee that was hired in the middle of the year, they'll need a record for the time that they were not an employee, where they were getting no coverage. And for that, there's a box 16 safe harbor of 2A, which means the employee was not employed. So you would use 2A for that record when the employee was not employed, and therefore they got no offer, like a 1H, let's say, for January to June. And then when they become employed, they're most likely going to go through a waiting period. Well, I shouldn't say most likely, but some clients will do a 90-day waiting period. I don't think that it's required. Bonnie, correct me if I'm wrong.
No,
they could just enroll.
They can make the offer immediately. That'd be fine.
Yeah, they can make the offer immediate if they want to. So there's a couple of different ways to do that. And if the waiting period is essentially the 1H, but there's again a safe harbor code for it. It's called limited non-assessment period. And that basically means the employee is being tested for the 30 average hours, and they're in that waiting period. Okay, so we're not sure if they're going to be full-time, part-time, in order to if they have to get an offer or not. So that's where those 90 days or that 3 months, if they were hired in January, it's 3 months after that. And for purposes of, I'm going to be talking about months and versus hire date. If you're hired in the middle of the month, for the most part, that you're going to be 3 months after, as I mentioned before, the way the report works. It's going to be 3 months, 3 full months. So so if you were hired in January, you're going to be waiting through February, March, and April, and in order to test your hours, and then you'll get an offer of coverage in May. So we just key in these records, keeping track of the employees as to, how they're transitioning, and then key in the appropriate records. The other method is using the Excel spreadsheet that we've developed in order to import the data instead of having to key it all in. So it's the same fields: client number, the year, employee number, begin and end month, and then your box 14, 15, 16, and full-time indicator. Okay, and the way I have this organized is by month. There's a lot of, I shouldn't say a lot, but there's a few different ways to import this data. Not import the data, but there's only one way to import the data, but to organize the data. Okay. Just depending on whatever works best for the client, I'll talk about 2 different methods. Essentially, the first school of thought is to determine your starting point on January 1st, 2015. Okay, here's my list of active employees as of January 1st, and we can obviously use the average hours report because we've got all the dates on there. All my filtering's turned off. So we've got the hire and termination dates on here. So I'm going to switch over to my January worksheet. So I can determine, who was, if I want to filter out anyone that was terminated in 2015, I'm sorry. I want to do the year 2014, who was terminated in 2015, and that'll give me my essentially you want to start with an active list of employees. Okay, who was active as of January 1st, and of those employees, is there anyone in that transition period? Okay, so that's essentially what January would start out with. Okay, let me start at my who was active as of January 1st, and therefore and of those employees, these are all full-time employees I'm talking about. Of those employees, is there anyone that's in the waiting period? Otherwise, all the other full-time employees are getting an offer. Okay, let's say my plan year starts January 1. Then, as we run the average hours report, we're picking up employees. Let me clear the filters. That were hired in January. So we essentially we have a starting point. Now we're going to start adding employees into the list. So now if I just look at everyone that was hired in January, okay, here, so I've got 10 employees, and then of those I can filter the average hours, and it looks like there's no one even with an average hours of 30 or more for the test. So essentially I would run this for every month to see, okay, who's been hired in the month, and who do I need to add to my list. So I'm keeping basically a running list of employees to upload these records. So really, the 2 schools of thought, the difference between them is basically if you want to just put in just assume that the employee is going to be an employee for the entire year so that their offer is not going to change. And then if they do change, you handle them later. Or the other school of thought is to just load a copy of the employee list for every month, where you're just adding in new employees and you're terminating the old employees. So that's basically it. And if I could have everyone mute their line so we don't get any feedback, that would be helpful. So as I said, what we can do is load all these employees as of January 1st, all my full-time employees. I'm going to say, okay, I'm going to assume that they're just going to be working for the entire year. And then when I'm running the monthly average hours report, and I filter it for just employees that were terminated in the month, so I can do it that way too. I can say, okay, show me everyone that was terminated in January, and of those employees, who's on my list as full-time, and then essentially turn off their offer in the month in which they were terminated. We're also planning on doing an enhancement. It's in development now, where instead of going back and editing the record yourself, the system will edit the record for you automatically. So let's say an employee started out January 1st, and we submitted a record of 1 to 12. We were assuming the employee was going to be employed the entire year, and so we're giving them an offer of coverage 1A for the entire year, okay, 1 to 12. Then they're terminated in, let's say, July. So therefore, August through December, they need essentially another offer and coverage record with the new codes. So a new code, again, where they're not getting an offer because they're no longer an employee. There's a box 14 and 16 codes for that. But again, that's a new record. So in that month of August, I can just send through another record. Let's say if I'm just going to copy this and paste it out, where it would be 8 to 12, and again, they're not employee, no offer of coverage is 1H, and there's no offer because it was 2A, they're not employed. So then in another file, in a separate import for the month of August, I'm going to say, okay, this employee was terminated in July, so when I'm doing my terminations for July, I'm going to send through a new record here with 8 to 12. And what the system's going to do with this new enhancement is it's going to go back to the original record, and it's going to put in a 7 on the employee's original record. So it says, okay, you're telling me that this employee has transitioned, and therefore they're going to, we can't have an overlap, so we'll go ahead and fix it for you to put a 7 in. Okay, so that's the second school of thought, basically. So it's either you load all your employees with 12 records, one for every month, where you start out with a baseline, and then by month you figure out your transitions, who's being hired, who's being terminated, and if you're using a waiting period, who's coming out of the waiting period. Okay, so again, a new hire is going straight into the waiting period for 3 months. Then at the end of the 3 months, they're coming out of their waiting period. That's another record. And then if they're terminated, there's another record. Okay. So again, the first school of thought is either you're loading the same list of employees every month, or the other school of thought is you load one complete list at the beginning of the year, and then you just load your transition employees. So employees that were hired are coming out of their waiting period or terminated. And that's obviously a lot less data to deal with, but it just needs to make sure that we keep everything straight from data point of view. Bonnie, did I miss anything on that?
No, I think that sounded pretty good.
Let me switch it back over to you for the final step, which is the electronic file.
Yeah, I mean that's very there's really not much to say about that other than, I don't know what happened to my screen. There it is. Basically what we're going to do, once you get the forms out to your employees, which are due out to the employees by January 31st, next step will be to create a file that has to be sent to the IRS by the end of February, I believe, or by end of March if we're doing it electronically. So we'll create that file to be uploaded to the IRS. Did you want to add anything to that?
Yeah, let me just switch over back to the focus application. So right now we've got buttons on the health insurance reporting menu for the programs that we have in place. So you've got your setup form, your transmittal form, which I didn't talk about during this webinar, but we've talked about it in prior webinars and we've got it all documented. It's very high level. It's all about the 1094. The employee offering coverage, which I showed you at the beginning. We have a verification report, the offer and coverage report, to make sure all the data that you have loaded is correct. And we'll check things like, hey, you're giving me an offer and coverage record that starts in July, and you give me from January to June. So it's going to print messages for those kind of issues that it sees with employee data, the offer and coverage data. And then the spreadsheet imports, of course, we were just talking about. We didn't talk about the covered individuals because most of the time that data comes from the, it's only required for the self-insured or self-funded, and most of the time it comes from the health insurance company anyways. Unless the employer is keeping track of all that themselves, they should be able to upload that data pretty easily. But my point is here with this new screens, we have a release. Our release for the printing the forms is October 15th. We're going to do a release on October 15th. It's got a lot of other program enhancements, but it's going to have the forms printing on it so we can begin to let clients get a look at them, how they're going to look and feel, basically. So those buttons will be added in here in order to print the forms once we've got the data loaded. And then by the end of the year, we'll have the electronic file. So essentially clients will, applications clients will generate the electronic file, or FMS will generate the electronic file. As far as submitting it to the IRS, we're researching ways in order for us to submit it on behalf of the clients as the submitter. However, it could very well be that for this year, while we're trying to just juggle all this information, this whole module, that we might just have the clients upload it themselves, and we'll definitely make sure that we give them a heads up and plenty of time to register themselves and that kind of thing. But essentially, we'll generate the file and give it to the clients. They'll go to the IRS website and literally upload it to the IRS website. A lot of clients now, for example, for the W-2s, we have the program MasterTax that just does that for us. It sends the file electronically to the IRS. That's what we're going to try and emulate without MasterTax, doing it ourselves for this, the 1095 or the PPACA electronic file. So that's our goal. But right now we're still in development right now. So as I said, that's the employee. That's what buttons are going to come next here towards the bottom of the screen. Some questions in the chat box, or again, go ahead and unmute if you have questions. We'll go ahead and take those now. But let me answer one real quick. Did you say that each employee form has to be filled out, or did I misunderstand? Basically, the offer and coverage data that we were talking about translates into the 1095. So the program is going to generate this form just like it does the W-2s. Okay, that's what's going to happen. Just picture it like a healthcare W-2, where the system is, when you say print, the 1095Cs, it's going to come out looking a lot like this, with all the data filled out based on the data that we have in the database. One page for each employee. It's going to be very similar to W-2s in that it's going to be self-sealed. It's going to have the, we're going to run them through the sealer machine, and we'll pack them up and mail them to the clients for distribution, or we'll offer mailing with postage extra. But essentially, it'll be sealed up with tear-off edges, just like the W-2s, with the return address for the client and the employee's address there on the front. So go ahead and speak up if you have questions, so Bonnie and I can answer them. Hopefully we didn't confuse anyone any more than you already were on this stuff, but hopefully we helped this time to clear up some of this information.
I would like to add just one comment. Even though we're going through what needs to be done for 2015, which is actually absolutely critical, but also everyone needs to keep in mind that what should be happening probably the end of this month is to start on next year and the offers for next year. So they need to be going through all of these steps, not only to get 2015 squared away, but to also get started on 2016. Okay, that's all I had.
Great question. Is it the responsibility of the accountant or the client or employer to get the information into the system? So I was referencing earlier about downloading the CSV file that I've been using this whole time, and what clients can perform data transfers and what clients cannot. It will be the responsibility of the accountants to transfer, to use the data transfer utility to import the data, okay? And that's really where our fees that we're charging the clients come into play, is for us to perform that work. It's very similar. I believe you guys do the same thing for the total cost of healthcare on the W-2s. This whole process sort of emulates that in the spreadsheet import process. So the client will prepare these. Let me switch to the spreadsheet. So the client will prepare the offer and coverage spreadsheets, and then will be sent to the accountant. The accountant will then either, if it's not already, get it into the CSV format, just save as a CSV from Excel, and then use the data transfer to upload it into the system. Then the clients can run the offer and coverage report themselves. So that's not necessarily required of the accountant, but it's really to perform the data transfer itself. Unfortunately, OIS clients, AES clients don't have the ability to transfer files kind of on the fly like this. So it will be the responsibility of the client to do that. That was a great question. Yeah.
Basically, at this point, the options for the client is they can either give us a monthly file and our accountants will upload them. They can do it all at once, or they can do it themselves and just hand key it.
Correct. I would strongly advise against the end of the year thought process. Just the fact that we'll have to warn them that this is, this is new for everyone. It's going to be a lot of work, and we want to get it done as early as possible. And it even helps to just perform these functions now for January and months that have already passed, just to get into the routine, so that we're not starting from scratch, getting the ball moving, January 1st.
Yeah,
January 15th for that matter.
So that's the other thing too, is I agree with you. What I've been getting so far from a lot of our clients is a very passive approach to this, where we brought it up and they just act like they don't even know what's going on. It's borderline ridiculous. Like, we're babysitting them and we're getting them information, and then they're acting like they don't want to have anything to do with it.
I think we talked to John about setting a deadline as well. What are we going to do if they go past it, But I think we definitely should set a deadline of early January to have this information to us at the very least. But also at the same time strongly recommend that we start now. I had another point in my head, but I forgot what that was. So yeah, I think, oh, to your point, Matt, about the clients and their haphazard kind of dealing with this, that's really the point of this webinar, that Bonnie and I are going to do this same webinar for all the clients that have signed up for our service. So it's kind of like a little bit of a wake-up call to sort of understand exactly what needs to be done here. And obviously I'm going to improve that final part about the offer and coverage upload to make that a little bit more clear, so that they understand exactly what's required of them.
And then, Chris, just one last thing. What exactly is our expectation, like from office to office, if a client calls and says, you know, what am I supposed to be doing about this? I mean, what is our expectation besides giving them the, you know, the information we know about, you know, how they can enter it? But what beyond that, what are we supposed to be saying to them, if that makes sense? Like,
well, it's pretty much exactly what we just went all through. I mean, are you an ALE member? Do you have to comply? Do you have minimum value coverage? Affordability? Is it affordable? You know, are you tracking your employees? But ultimately, it's that last part where, you know, you really need to start determining who got an offer of coverage in January. Let's just start there. You know what I mean? Determine who got an offer, and then go month by month, essentially from there. We have, to answer another question, we have distributed out the manual and all the spreadsheet templates to the clients, so they should have it. But I would definitely work with the individual clients to make sure that they have it, and to make sure we'll send you guys the invite. You can forward it on to your clients for the client version of this. Bonnie and I are going to do it. I think it's within a week or so. Everything's being sent out via email. So we just need to make sure that if we don't have an email address on file, or we have the wrong person, we've got an accountant versus a payroll person or something like that, we definitely need your help in making sure that everything, the documents, the spreadsheets, and the OIS manual version of the manual is sent out. The clients have a clear understanding of what's required of them, and that they sign up for another webinar that Bonnie and I are going to do probably, I think it's going to be in 2 weeks.
And so those webinars will be recorded, so even if someone can't go, we can point them to a YouTube video to watch it?
Yeah, exactly.
Okay.
Okay, sounds good. Well, if there's no more questions, then I want to thank everyone for listening in. Definitely don't hesitate to give Bonnie or I a shout if you have more questions. Have a good day. Thank you. Bye.
Thanks, Chris. Thanks, Bonnie.